What is up, future rich bitches? For those of you who are new here, I am Madeline, and at this channel, I give women all of the information that they need to feel confident to start investing and building their wealth. So if that's something that you're interested in, please make sure to subscribe. I release a new video every Saturday, so in just 15 minutes a week, you can start to build your financial literacy and be on your journey to becoming a rich bitch. So today we're going to talk about how to financially plan for the next recession so that you don't lose all of your money. And this is a common fear, especially I think among millennials, because if you're like me, I turned 18 in 2008 and studied finance in college during the first few years of the 2008 recession. And I saw all of the devastation that can be caused when a recession hits. So if you're a millennial like me, recessions probably give you some serious anxiety. And at the beginning of 2020, most economists and people who just track and follow the economy thought that we were kind of due for a recession. We had experienced the longest economic expansion in modern history, so at some point the market is going to correct. And I would have agreed and said, yeah, we're probably due for a little recession. But since the Great Recession in 2008 had been compared to the Great Depression of the 1920s and 30s, then, I thought, okay, well, a huge recession or depression like this is going to be pretty far off, right? Well, not so fast. Coronavirus had different plans for us. And so now, for millennials especially, like, all the trauma of 2008 is back in full force, and we're like, what the fuck are we going to do? And is this going to happen every decade? How can I just survive this many recessions? So I'm going to give you 3 tips for how you can financially prepare for the next recession, because if these 2 have taught us anything, it's that more are to come. And if you have gotten through this one without losing your job, first of all, congrats. But next time you might not be so lucky. And that's because recessions are caused by different things, and depending what causes the recession influences what industries and companies are most at risk for, having issues and losing money and then laying people off. So like in 2008, there was a lot of mortgage defaults, so banks and insurance companies and those types of things were hardest hit and first hit. And then this time, because of social distancing, it stopped travel, we can't go out, so service industries, airline industries have all been super heavily affected. So it's really going to depend on what causes the next recession that which market sectors and companies are most affected. So the first thing that you need to do is build yourself a 3 to 6 month emergency fund. And I literally cannot stress this enough. I have so many videos and blog posts about why building an emergency fund is so important. And I think it's the thing that people want to skip because it doesn't really, you don't make money off of it. Like, it's definitely not sexy at all to have a savings account, but it is so important. And trust me, if you are skipping cocktails with your friends right now, they may think you're weird, but when you can pay your rent through the next recession and they can't, they're going to be pretty jealous. So it's super important that you just start automatically contributing to a savings account right now and aim to have 3 to 6 months of expenses saved in a high yield savings. This will be a godsend if you lose your job in the next recession, because it's going to allow you to pay rent and put food on the table and maintain your life so that you don't have to focus on scraping together pennies to make ends meet and pay your rent. You can instead focus on, what are my moves so that I can make sure that I can get a job and that my future is going to be brighter than what's in store right now. And if you had to spend all of your time focusing on making ends meet, you wouldn't be able to really make sure that you can secure a job that's going to give you a comparable salary and what your future moves are. Instead, you would be focusing on the now. So your savings is so important. If you really want to rebound from this as fast as possible, it can help you get through the now. You know that that is covered, and then you can focus on your future and what your next moves are. If you need more information on how to start a high yield savings and set that up, I will link a video to that and my blog post on that for you in the description box below. So make sure to check that out if you need help setting up your emergency savings account. So tip number 2 is going to be to invest in the stock market. And the S&P 500 is widely regarded as the best gauge of kind of what the economy and the markets are doing. I know right now the market does not reflect the economy at all, but in 2008, the S&P 500 entered a bear market, which means that stock prices were declining. And after 2008, it took about 5 years for the market to recover to its pre-bear market pricing at around $1,500 per share for the S&P 500. But since then, shares for the S&P 500 have more than doubled in price. So investors who lost money in 2008 have made it all back plus more. So the market is going to rebound, and the key to not losing money in a recession is to stick it out even though it's scary. So once the prices decline, a bunch of people start to sell. And that's a problem because what it does is move your paper loss to a real loss. And so a paper loss is just like, oh, okay, I see that the price has gone down and I've lost money in theory, but until you sell those investments, you haven't actually lost any money. And so if you don't need to use the money that you have invested right now to like pay your rent, which you shouldn't because you set up your emergency savings account, then you can just leave your money invested. And if you had done that, like by now, you would have more than doubled your money and you wouldn't have lost anything. So it's really important that when the market declines and it gets really scary, that you just stay the course and continue to invest. And eventually there are earnings on the horizon for you so you can actually make money coming out of the recession instead of losing it by selling during the bear market. Another great thing about having investments during a recession is that if you're invested in a diversified set of investments like the S&P 500, which is a conglomeration of 500 companies, then some of these companies are going to pay dividends. And a dividend payment is just a portion of a company's profits that it pays out to its shareholders. And when you're trying to grow your wealth, you typically reinvest those dividend payments so that you can earn more from them. But if you need money during a recession, they can actually serve as a source of passive income for you. And instead of reinvesting them, you can just use them to pay bills or something else that's needed. So if you're really in a bind, then these dividend payments can provide another source of income for you to rely on through these kind of tougher times. So then tip number 3 is to keep on investing even when you get really scared. So market crashes are terrible for the money that you've already invested, but they're actually excellent opportunities to make enormous returns on money that you haven't invested yet. So the key to doing that is to keep investing through the bear market. And that's because when markets drop, stocks essentially go on sale. And so it's like, okay, if you bought a dress today for $100 and then tomorrow it gets marked down to 50% off, then if you bought it tomorrow on sale, same dress, but half the price. And that's essentially what's happening when the stock market crashes. So let's assume that in 2008, you were an investor and you had the option of either continuing to invest through the recession or to, oh, I've got cold feet, so I'm going to just pull back and leave your money invested, but just not invest more. So before the stock market crash, S&P 500 shares were trading for around $1,500 a share. And then at the lowest point in the 2008 recession, S&P 500 shares were trading for around half of that at about $700 per share. So at $700 per share, if you had continued to buy at that price and invest through the recession, the shares that you bought at $700 would now be worth 5 times the value that they were in 2008 when you bought them. In contrast, if you had decided, oh no, the market is going down, I'm not going to keep investing, and just let that $1,500 per share sit there, you would have doubled your money, but quintupling your money is way better than doubling it. So This is why it's so important to actually keep investing through the recession if you can, because you're going to see returns that far exceed what you were doing before the recession. So these earnings can really help you offset some of the decline that you're seeing from the money that you already had invested, and then result in absolutely huge gains later down the road. But a really important factor in doing this is that you need to only invest in like index funds or ETFs. And that's because recessions, like we discussed earlier, they affect different market sectors differently. You don't really know until hindsight is always 2020. So you don't really know until you're all the way through kind of how everything's going to shake out. And so if you're investing in like the S&P 500, it's 500 companies. It's well diversified. If one of those companies fails, you're not going to lose all of your money. If you're hand selecting stocks through a recession, like picking the companies to invest in, you have a much larger likelihood that one of those could fail and you could lose a lot of money. So this tip really only works if you're willing to invest in more of the like boring investments like index funds and ETFs. I would not suggest taking this approach if you are looking to like hand select companies. Only do that if you're really willing to lose it all in the recession. So the easiest way to keep on investing through a recession is to just use dollar cost averaging. And basically that is just a super fancy way of saying invest at regular intervals. So I would suggest that now, since, I know the market is volatile now, but we're in the recession. And if you can and are investing now, I would suggest just setting up automatic contributions while you're still okay with investing. I think if you wait until the next recession to do this, you might get cold feet and be like, I don't know, like this seems kind of scary. But if you just set it up now, then your automatic contributions will be going when the next recession hits, and it will hit. So then you just don't even have to think about it. And as long as you're able, you can just keep contributing. So you can set up automatic contributions just to pull weekly or monthly or whatever frequency that you're comfortable with, and then you will automate your investing. This is not only great because then you will get to take advantage of drops in the market when they happen and buy at those prices, but it also just makes everything so easy. Like you never have to think about transferring money into your investment accounts. It just is going to happen for you behind the scenes. You're going to be investing and making money with like zero effort. So super important. I would highly, highly suggest that you just go ahead and set this up now with any investment accounts that you have. Another thing to consider is that if you have a 401k, you're already doing this because you contribute every time you get paid. So most people are really only investing through their 401k. So if you lose your job in the next recession, that's all gonna go away. Obviously, your investments will still be there, but you won't be making your contributions to take advantage of the lows in the stock market. So if that happens to you, I would suggest setting up a Roth IRA. Your contributions and earnings grow tax-free forever, which makes them amazing. And then you can set up automatic contributions. Again, if you lose your job, like this sounds great in theory, but if you're really struggling to get by, do not start investing. You should only ever invest money that you're okay with losing and don't need in the short term. So make sure that you don't set up a Roth IRA and start contributing if you aren't making 401k contributions because you lost your job, unless you are absolutely certain that you are financially stable enough to do so. And that's really it. That's how you can prepare and not only have some financial stability throughout the next recession, but to actually hopefully come out ahead and make huge gains on your investments. So I really hope this helped you understand how you can build some financial security that you can rely on, maybe use some passive income if needed in the next recession, and make those gains. So I hope this helped. Thanks so much for tuning in. If you liked this video, then please make sure to hit the little thumbs up below. It helps with the algorithm, and I want to be a rich bitch just as much as you, so I'd really appreciate it. Also, if in just 15 minutes a week you want to build your financial literacy and get your journey moving on becoming a rich bitch, please make sure to subscribe to this channel. And thanks so much for tuning in. I will see you soon. Bye!